When you're reading about hot stock tips on financial news channels or Reddit, but you still feel why your portfolio is failing to grow, it's time to take a different approach. Suppose you are the most unfortunate of investors. In 2007, you invested all your money in the stock market just before the crash. Then again in 2020, right before another crash. With such an awful timing, but had you just held on to your investments, you would be richer today. The truth of the matter is that 90% of the individuals lose their money in the stock market not because the market is poor, but because of the way they invest. The first one is to know that you have to select your strategy. Are you a trader or an investor? Traders chase quick wins. They tend to bet off of hype or headlines. Investors, however, are long-term thinkers. Their business goal is to maintain good assets in years, decades. Trading may be thrilling, but if you wish to be sure of growth, then long-term investments are the best solution. In investing, one can find three major directions: passive investing, working with a financial advisor, or active investing. Let's explore each. Passive investing is simple. You invest in a wide section of the market and retain it. The stock market has averagely paid off at 10% yearly within the past century. That is recessionary periods and over 25 market crashes. S&P 500 EG contains 500 largest American corporations. You do not have to purchase one of them separately. Rather, you may invest in an index fund, such as SPY or VOO, that provides you with immediate exposure to the entire index. In this strategy, you do not need to follow particular companies. An index is automatically removed and replaced in case of any poor performance. Suppose you invested $1,000 a month over a 30-year period. At 10% per year over time, you would have nearly $1.9 million in it. Naturally, that payoff is not assured. In some years it will be higher, in other years lower. History teaches, though, that stability will reward. The important part of this framework is what most people call the always be buying strategy. You continue investing whether the market is good or bad, in the period of political change, or when the economy is in decline. Markets crash, and the best deals tend to be when such a crash takes place. Rather than panic, experienced investors consider bad times to be a chance to invest more at a reduced rate. Next, we will consider the second alternative, the possibility to work with a financial advisor. This could be appropriate to those individuals who like a hands-off leadership style. You deposit the same, say $1,000 a month, and the decisions are made by your advisor. Assume that they give a 11% yield, slightly better than the market average, and they impose a 1 to 2% fee each year. In 30 years, those fees will cut your overall income, and you will have about $1.8 million. Not bad, only less than in case you had simply purchased and owned an index fund with no fees. This track provides a sense of calm, though you must know how your advisor is getting his or her money and what they are putting their money in. Similar to how you would seek a second opinion when it comes to a big medical diagnosis, it's often a good idea to ask questions and consider whether the strategy being presented by your advisor fits your goals. The third alternative is to act as an investor. This is in form of researching yourself and selecting specific stocks that you are confident will appreciate over time. The error that most investors commit is trading as traders once a stock falls a few percent. They become anxious and make premature sales. In order to flourish in this, you must have patience and a plan in place. This is by illustrating the fact that despite having the same 10% per year in earnings, you are earning 13% per year, and you invest the same $1,000 monthly in the portfolio over the 30-year period, your portfolio would have more than $3.5 million. It is over $1.5 million more than the passive investor. The catch? Higher risk. It could be that you get 13% returns, or you get 2% returns, or perhaps even negative returns. Then, when you take this path, you should be willing to put time in learning and researching. Identify long-run patterns and track capital flow, not headlines. True returns usually are the product of beating the market. Think of identifying an emerging business when it is not yet the next big thing. That is the way active investors gain an advantage. One of the errors not to make: monitor the prices of your stocks too frequently. Imagine that it is the house purchase. You would not test the value of the home every couple of hours. You should be long-term oriented with investing. There is no need to doubt the company, but rather trust the process and allow time to develop. All investing options are advantageous and disadvantageous. Passive investment is standard and untroubled. The use of a financial advisor will be convenient and fee-charged. Active investments may yield more returns, but it takes knowledge, time, and a greater stomach to ride the casino. In conclusion, choose whether you are suited best to passive or advisor-led or active investing. Whichever direction you choose to go, do not forget that you are aiming at long-term wealth and not a quick fix. Anyone can expand his money with discipline and education and a stable approach.